Hi everyone, so today is Anika Araya, Akra. They've had a very strong first quarter sales growth, much higher than we expected. That's because the petroleum trading, the fuel distribution has jumped to positive growth from negative, up 37% in the first quarter. So that's much better than we expected. So we assume after a weaker second quarter that sales go back up to this trend and 16% growth over the next 12 months. And then in terms of cash flow, a very familiar story. 2015 into 16, negative cash flow, and then positive again in 2017-18 thanks to these investment gains here. Then negative again, but last 12 months the cash flow is back to positive. And with our sales growth, we're forecasting a little bit more positive in the next 12 months. There's been net debt all the way through. This came down to 1.4 trillion thanks to the investment gains, but it's climbed all the way back up to almost 3.9 trillion. But that's improved a bit because of the recent positive cash flow again, and then with our positive cash flow forecast, this should come up towards 2 trillion of net debt. Profit, we can see here that the profit has come down. That's as the margin declined. So we can see what's happened to the cash cost margin here. There's a bit of a difference between the cash flow and the profit in terms of costs and revenue, but we're going to stick with using the profit to calculate the costs. What we've done, so the 12-month is actually 95%, the cost ratio, but the cash flow is at about 97, so we kind of split the difference and using the 96. So we get slower profit growth than sales growth, 1.1, as we're assuming the cost ratio goes up a bit. And then for valuation, so that's the free cash flow, over 700 billion with our 1.6% and a 50% discount, and that gives a target price of 5,944. It's trading at just 0.35 times the sales, 0.84 times the assets, and below book value, even though it is profitable. Okay, there's the target price, 1.5 times upside. See you next time.